It's time for our quarterly chat with the top management of TCS. I have with me the CFO and head of HR. Gentlemen, good morning. Thank you for joining us.
Good morning.
I scanned through the numbers as I always do after your quarterly release. The headlines are very impressive. However, analyst fraternity and street is divided on one aspect, which is that why is the constant currency growth for Q2 lowest in last 6 years? How would you like to defend that?
So first, let's talk about the absolute numbers. In terms of absolute numbers, we have had a decent quarter, 3.9% CC growth, and dollar growth of about 120 million. It's a second sequential quarter of 100 million plus incremental dollar growth, and the quality of that revenue growth has also been very good. Our margins have expanded by 80 basis points, of which 10 basis point is underlying core business expansion. Another 70 basis point we have captured the exchange impact. From a cash conversion ratio also it's fairly decent. We have done about 5,400 crores of cash from operations this quarter, even despite a fairly large tax outflow in the second quarter. So overall, from an absolute perspective, it's a fairly good quarter.
Headlines are great. I'm with you.
Not just the headline, structurally each of the individual sublines are also good. But I agree with you that there is a difference between what the overall street expectations was and where we are at, and that is something that we need to deal with.
The communication from Chandra yesterday was the order book is at a record high. In fact, Q2 was one of the best quarters in terms of fresh order inflow. How come that is not getting translated into constant currency growth?
The translation of that will take its own sweet time, because order book is obviously a better measure of future business rather than the current period business. So I think that reflects overall positive, confidence in the overall market, primarily stemming from the major geographies. But that, how it translates into revenue, will take its own time.
So how should we read into it? Orders have come in. How long before they will translate into activity, into revenue?
How to read into it is, I think it's a data point in and of itself. And I wouldn't put more than that. I mean, I'm more of a
you're the man with numbers. You're the man with numbers.
Yeah, that's so professionally challenged to look at the number that is already in rather than the number that will come. But it's a data point, and we need to keep that in mind. And in addition to all the other data points.
Well, it's the attrition number. It's come down. You are confident it will come down further. Why is that?
I'm confident. Why it
will come down further? Because last time when I interacted with you, you said, look, it's retaining talent is becoming challenging in the startup world.
So it's not only the startup. It's overall what I said is Q1 and Q2. These are the two cyclical kind of quarters where the attrition goes up because of many reasons, right? Because people leave for overseas for higher studies, or even in India for higher studies. And then we complete our annual appraisal process, and as a result there are a few who would like to leave and things like that. So these are primarily because of the Q1, Q2 seasonality. So I said as we go forward from Q1 to Q2, it should definitely come down, and then Q2 to Q3, it should come down from where we are at this point in time. There are multiple things that we are doing at this stage. So if you have looked at some of the reasons why people would stay is because they see that the career that they have is challenging. The kind of jobs that they are doing is challenging, and there is a good focus from our point of view in terms of employee engagement, in terms of training. We announced 100,000 people being trained on digital, so that's where the future is. Everyone is getting trained in TCS in digital. We have completed about 30,000 people who got trained during this time. So there's a lot of momentum in employee engagement, and that is what is helping us in order to retain our employees.
You've increased your hiring target. Now there are two ways to look at it. A, that's largely you're filling up for your double-digit attrition, or this is an indication of where you see growth. So how should one read into it?
See, the whole recruitment that we do in a year, it depends upon the workforce that you would need in order to deliver the kind of business that you are forecasting, and the kind of demand that each customer at different customer sites that you would have. So of course, attrition is one of the parameters that you have to take into consideration when you do your workforce planning. So taking that into account, taking the growth that we have in future, and future does not mean only Q3, Q4, also year ahead. So looking at all that, where we are at this point in time, we said we have already done 45. Looking at what our future is, we said we would definitely need and we think that we are going to cross 75 or close to 75. So we said, so that is
but
the reason why it is 75.
But if the attrition number was not in early teens, would you have increased your hiring target?
See, if, as I said, attrition is also one of the factors. One of the factors in arriving at what your total workforce that you need, plus the kind of demand that you have in terms of competencies, in terms of where that demand is, and what kind of skills do you need. So it's all this. Attrition definitely is one of the factors.
You know, as journalists, we are programmed only to talk about the bad news and find the fault lines. I don't want to do that because there are a lot of good news. Order book at a record high. If I take the clock back about a year ago, there were half a dozen problems for TCS. It was India, it was the telecom vertical, it was oil, it was LATAM, it was Japan. A lot of those problems are getting sorted out. So directionally, if I look at the messaging from the top management, can I safely read in between lines and assume that it's getting better?
Absolutely. I think structurally some of the problems that you said have gone away. Some of them continue. But overall, I think I wouldn't say that we are looking into it from a very negative perspective right now. As I said, we are poised for, positioned for growth, and it's on a more positive note that we are currently at.
But business momentum highest ever.
Business momentum, you see, again, lag measure, obviously no, because the numbers are coming in lower than that. But when we look into the future, we expect a better movement. That's why we shared that number with you. And again, if you look at it, the largest geography is likely to do good because growth momentum is coming back, and there. Industry-wise also, when we look at it, even within insurance, which was a slightly challenged one, we see the US insurance side of it starting to pick up. So again, as I said, individually when you look at the details, it is overall a better story. Obviously there will be areas like energy which will continue to be weak, Diligenta continues to be weak, but otherwise it's not a bad one. India did very well at this time. But some of these peripheral geographies are volatile by nature. So India, Middle East, LATAM, they will do well in 1 or 2 quarters, they might do badly. But US is where the expected growth is.
Your US growth, at least for the quarter gone by, I'm using a magnifying glass here, is not in line with your historical averages. Should we read anything into it?
No, because as I said, again, there is a lag and there is the lead one. From a lag perspective, it is right. It's slightly lower than what we would have put it out. But we see momentum coming back in US, and we hope to capitalize on it as we go forward.
You embarked on a massive training program, nearly 1/3 of your workforce. You mentioned that about 30,000 professional employees have been trained. What is the progress there? And once the entire training program is complete or will get over, what will change?
See, from what we said, that this particular year we will be training about 100,000 people on digital technologies. So from there on, we have been working on various training programs that we need, which is aligned to the vertical requirements. BFS would have a different kind of need vis-a-vis the retail. So all that has been done. The number of training programs, some of this content has been curated internally, some of this content we have sourced from outside, and the whole digital platform has been put in place. Platform in terms of it is the learning exchange that is there, which can be accessed anytime, anywhere by our employees globally. And also in terms of the classrooms, which are where we have invested over a period of time, where these are what we call as integrated classrooms, where you can do things from one place, but then everybody participates in the training program. So all that infrastructure has been put into place. The training, the learning exchange is put into place. The various training content has been created, and about 30,000 people have gone through the program. The training is something which is at different levels. So from awareness to the competency levels are different for these training programs. All that is in place today. And that's the training that is going on. What you're asking is, from 100,000, where do we go next? So what we are talking about is a technology refresh. And once this technology refresh takes place, usually as we go forward, more and more people will be required on the digital technology, and we are preparing ourselves for that.
So it's a larger program. It will go beyond 100,000.
Absolutely, absolutely.
Your order book is great. Deal momentum is strong. How come that is not getting translated into a pricing advantage? Is that largely because there is a price war within the industry? So you're getting better orders, but when it comes to pricing or when it comes to billing rates, the customer is not ready to pay out more.
So on, as we said, there is no structural breakdown in price. It's in the nature of the industry that the newer technology will command a better price, whereas the existing technology will always keep on getting a price discount, and that play is currently on. There is also the impact of geographical dispersion. So if you look at the current quarter's numbers, you have seen that the growth has happened from multiple other geographies where the price points are not necessarily different. So pricing, when it is compared on a like-to-like basis and keeping in mind these kind of structures, we don't see any major breakdown. From what we report is realization, that is beyond just pricing, and from a realization perspective there is cyclicality to it also, because the number of working days on it also has an impact on it. So overall we see stability from a structural price environment perspective, but realizations will remain, the reported realization will remain volatile.
It's a well-known fact that second half is a historically lean patch for Indian IT sector per se. Can I safely assume that this time around that cyclicality will play out?
Oh, absolutely. There is no, because again it is a factor not in terms of just the demand, it's about how the holidays are. We are going to have 3 less working days next quarter compared to the Q2 that went by, and overall the business momentum does tend to taper off towards the end of the year, and in the next quarter, which is Q4, it takes time before it builds up. So that cyclicality is highly unlikely to
but at a time when you're migrating towards new technologies, which is digital, Snack, mobile, customers frankly now shop 24/7 and they can bank even on a Sunday. I understand that traditionally because of holidays there used to be a lean curve which came in, but purely because the business model for Indian IT sector is changing. It's not just coding, it is now in customer experience. Do you think the historical variance which we've seen, that could change now? It may not happen this year, but are you headed there?
We'll need to wait and see on that, but remember that our participation is on the larger programs rather than just the immediate short programs, and even the short programs for the retail sector, if you take it, it's a good example, where maximum activity happens in the holiday season. Retail sector tends to actually lock down its technology going into the holiday season, because they will not promote any new programs into production as they try to. They might tinker with the front end, but nothing substantial. So that is unlikely to change. Whatever happens will be on the front end little part of it, but that will not change the cyclicality. But all of this is obviously based on historical averages. As we go forward, we'll see. But I don't expect it to change much.
So how was Q2 different from Q1, and how do you think Q3 will be different from Q2?
Q2, actually, if you look at it in terms of individual line items, again, as I said, there is some amount, in some of the more stressed ones like insurance, we see some amount of momentum coming back, and we definitely see, we had good product sales, so which is always a good sign, because that shows an investment cycle coming back up. So individual line items are more positive in Q2 than Q1 was. Q3 is going to be, we'll have a better feel of Q3 only in November, because as these planned furloughs get announced, we'll get a better sense of how much stress there is in the system.
But so I can safely assume that you are entering, you're migrating from Q2 to Q3 with business momentum, with a strong order book, with the assumption that there is all-round growth. These are standard and safe assumptions, right?
Those are standard and safe assumptions, but again, as I said, that's always been the case in Q3. Right, because you exit Q2 with momentum, but Q3 is a dampener, so that cyclicality you should expect.
The difference, according to me, between Q3 2014 and Q3 2015 is that number which I got from Chandra. Order book at a record high. Order book in Q2 was 30% higher than your best quarter ever. I mean, these are, TCS never gives numbers, but this itself is a big guidance, isn't it?
No, we don't give guidance. Again, as I said, that's a data point.
It's a data point. I am alluding to the data point which you guys referred to.
Yeah, so we'll wait and see how that translates.
Utilization rate is at 86%. No reason to get worried.
No, we have been operating at this level for quite some time. Last 4 quarters, we have been at this range. And in fact, utilization rate with trainees has dipped a bit, about half a percent.
But
that is because it's very acceptable, and that is because more of the trainees come in around this time. So that is where it is. So
on a longer term,
we would like to operate at this particular level.
But can you maintain it?
We would like to, yes. So that is the current plan. And see, at some point, I think percentage vis-a-vis the absolutes, that also has to be looked at. I think we have talked about it before. 86% means 14% of 325,000 people are not on customer engagements, or in fact you should look at it with 82.3, and the remaining are not on customer engagements. There are multiple things that we do, and that's a fair number of people. So considering the investments that we need in terms of R&D, in terms of various center of excellences, in terms of various IP that we are creating, in terms of management and all that, and the trainees that we are training and capability building. So all that, I think, given the 17% that we have of 320,000, that's sufficient number that we need at this point in time. So as we go forward, there is certain amount of percentage factor comes in, but more important is the absolute number that you need at a given point in time for these activities. So I think we would like to maintain it where we are at about 86.
The challenge for any HR head would be that how do I deal with legacy issues? And when I say legacy, I'm choosing my word carefully. It's just that technology is getting slightly, technology migration is evident. It's from social to mobile, it's from cloud to analytical. The world is evolving, the world will evolve.
Right.
So how do you deal with such a structural change right now?
So this is not the first time that we are facing a technology refresh. There are multiple cases where we have gone through a very profound kind of technology refresh. And in TCS, what happens is when we get people in, so it is people are on engagements at a given point in time, but then they have opportunity to rotate into various other engagements. You are today in a project where you are using a legacy technology maybe. Tomorrow you could be in a project which is purely front-ended digital kind of technology. So you are not branded on any specific technology for a long period of time. So that rotation definitely helps. And rotation not only on project to project, but also from country to country and location to location. So there are various other things, and the kind of investments that we make on each and every individual to develop their competencies so that they are ready and they see that yes, this is something that is as an investment that the organization is making in me, and my competencies are developing. So that has to balance out, and that has to play out. These are a few things I think which are very unique to us, and which helps us in developing our people and in retaining our people.
You know, every time when there has been a technology refresh in the past, and if I look at the track record of TCS has gained more market share, their margins have only migrated higher. If I take the clock from, let's say, 90s to 2000 and from 2000 to where we are right now, margins have expanded because you've got superior technology and you've got better talent. Can I assume the same this time around as well, that eventually market share gains would be higher? You are in a position to really capture the digital opportunity, and you will emerge as clear winner?
I would say definitely yes on the first two, which is we should expect to gain more market share, we should expect to gain more revenue. The margin profile of the new technology needs to be seen, because it depends on actually how it stabilizes, and we'll have a better feel for it only after it scales up.
It is scaling up, 13% of your total business now.
No, it's but digital in itself is a very heterogeneous mix. So you have cloud in there, you have mobile in there, you have analytics, you have big data.
But it's all new technology.
It's all new technology with very, very different, delivery structures underneath them. So unless you get scale in a given delivery structure, you will know what its optimized margin side of it is. It's a very umbrella, omnibus kind of a term that we are using. But underneath that, in the specifics of it, you have a very, very heterogeneous mix of...
But there would be a tipping point when you would say that new technology business is higher than old technology business. How far are you away from that?
In the past, when we've spoken about technology, there have been more homogeneous sets.
Okay.
So when we say that, e-business is X, that was a very, very homogeneous set. So underneath that 13%, each of these individually are still very small. Typically in the range of 10 to 15% is a very, very fair market share, but none of them are individually there.
What is the issue with Japan? You're still investing there. You've acknowledged it that, look, it's a market which is a slow market. So when do you think that market will pick up?
No, there is a question of the market picking up, and there's a question of us restructuring that operation. So we have taken over a $500 million business, which was structured very differently from our typical business. And as we cycle through that restructuring, you're going to see a bit of volatility. Depending on how the external market is, we would expect some growth on it. But that's going to take a year. When we had done it, we had said it will take at least 3 years before it stabilizes. We are into the second year now. But it is going to take time. It's not a problem that has to be solved. It's a path that has to be traversed.
Your margins right now, they are exactly in the midpoint of your guidance, 26 to 28%. Large part of your margin gain for the quarter gone by was a function of currency. The real so-called productivity levels did not kick in Q2. Now in Q3 and Q4, do you think they will kick in if you don't get a currency tailwind?
A large part of our cost inflation is also a factor of currency, because the reason you see the wage inflation in India is because of currency. So this is two parts to the same coin. So we can't, look at both of them separately. So I think it's overall, that's why we had given a range, and we are being able to position ourselves so nicely in between.
So you're happy where it is right now?
Yeah, fairly happy where it is. Yeah.
Ajoy, a larger question to you is that for last 5 years, we've seen a structural inflation in Indian economy. Now inflation has got crushed. Inflation is also a function of the underlying wage hike you give. So structurally, can then be an alteration in the wage hike because of inflation factor? I'm asking you a bit of a macro question here, but I want to get your thoughts on this one.
So we will look at what kind of increments we'll give at a later point in time. But if you look at structurally or at a macro level, the wages would be determined definitely by the cost of living in various countries. That is definitely one of the factors, but also it's also determined by the demand at a given point in time, and the kind of technology and competencies that you need. There are multiple factors that would play out. So it will be, we do our surveys at various points in time and then look at where we are and where we would like to be in order to retain the talent that we have. So it's a bit more complex compared to just looking at one of the factors, which is inflation. But if you ask me whether inflation and the cost of living has an impact on the wages, definitely it is one of the factors. That is
the disruptive part in the last 3 years was that IT companies lost a lot of talent to startup. They lost a lot of talent to new companies. Is that still a challenge, or that is now getting reduced?
More and more new companies is good for good for people who are going through various academic courses, and they have their own aspirations. So they are looking at what is it that they would like to do, and based on that they determine where they want to go. And see, today if you look at the supply side, so there is enough people that are available with the right talent, what we need for our business. It's a question of what you need and how you are going to go after that particular segment to attract the people towards your organization. So these are from my point of view, I don't think that's a worry at all. In fact, it is good for that ecosystem to have more startups, because that's something that is exciting for people to look at.
The other broader question is, in today's globalized world, when you're approaching more and more markets, in terms of a geographical approach, which are the new markets which you are now planning to enter, which you are targeting?
Our focus has been, it's pretty much the global GDP coverage kind of one. So Europe and Japan were the two big areas that we were not present in, which we are focused on. So we have made acquisitions and made investments in both markets, but they're still very small, and we will wait to grow that out. The other market where we are again small is China, but it will take its own time as we build out on it. So those would be the main geographical markets. We have a good presence in LATAM, and in the large developing markets, we are very well present.
Gentlemen, good luck. Thank you for joining us. And again, table thumping applaud. When I walked into this room, I thought it's only headlines which are better. Now I'm speaking to you, I'm getting a sense the entire construct of the numbers are better. We can always pick point 1 or 2 numbers, but generally the trajectory is important and directionally things are looking strong.
Right.
Appreciate your time. I'll catch up with you in the next quarter.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.